Build to rent, what I like about it is as you build out each unit, it may be a single family, a duplex, it may be a fourplex. But as you build that out, you get a certificate of occupancy on that particular property. And now you could go and either rent it out or sell it.
Welcome to The Path to Wealth, the show about well-being, fulfillment, and financial freedom. And I'm your host, Hannes Henty. Welcome back to The Path to Wealth. Today we have Jeff Greenberg from Synergetic Investment Group. Welcome to the show, Jeff.
Well, thank you very much for having me.
Yeah, of course. Always a pleasure. And why don't you tell us a little bit more about your financial journey when it comes to real estate? I know you've been in this, for over a decade, actually right around the first big crash, probably in my lifetime, that I experienced. So, you're a little bit more of a seasoned investor compared to me. So tell us a little bit about your personal journey around that.
Well, I started in real estate in about 2008 and then got into the commercial areas of real estate I bought my first apartment in 2010. So I've been in that part of it for about 12 years. And since then, we've done multifamily and student housing properties. And since then, I've been changing my path to the equity side of dealing with real estate, and now have a private equity fund where I help people get into quality deals with quality sponsors. But it's been quite a change from going from the GP side of it, where I was the main guy doing most of the aspects of everything, as well as teammates, and now moving more into the LP side, where we come in and help people get in on the LP side.
So what made you shift from structuring deals to helping people from a private equity side to come in as LPs?
Well, the main thing is that wasn't the piece that I enjoyed after going through the deals that I went and wearing all the hats. One of the things that I really didn't care to be is the asset manager. And as the asset manager, having a lot of the responsibilities of dealing with the property management company. And in some of my deals, I did have other people as asset managers, and decided, that just wasn't what I like to do. I like working with investors. I like educating investors, showing them how to get into opportunities, and decided, okay, I'm pulling back, and that's all I'm going to do is help people get into great opportunities and not deal with a lot of the other headaches of being on the GP side. And, it's a path, the reverse, that a lot of other people are taking. A lot of other people get into the LP side and they realize, I want to be the one in control. And they want to get more and more onto the GP side and then be the main GP. I decided I didn't need any of that. I want to improve the quality of my life, enjoy my time, and that was the direction that took me that way.
Well, I think other people still want to maximize on the returns, and they're willing to put in the effort on the GP side probably to get there. While you're now in a season of your life where you want to enjoy the fruits of your labor.
Exactly. And the thing is it was, we always talk about trading our time for money. And I decided this was a better use of my time helping people get in. And the thing is it is a challenge to find opportunities and deals, and the amount of time spent. I figured that I could spend that time finding operators that are spending all of that time finding the deals, getting into the deals, operating the deals, use much less of my time and be able to still get into those deals, maybe get a smaller piece of the operation or of the returns, but I could get into that many more deals. I can get in a lot more deals than they can get into because I can get in with multiple operators and get lots of little pieces and be able to bring people along with me and enjoy the spoils.
Yeah, that kind of aligns with my personal philosophy that as long as we can contribute capital, we can participate with the best operators in the best markets.
Well, it's in my case, yes, capital, that bringing the capital in, but in, what I tell new people coming in is finding something that you can provide. Now, in my case, if I can bring in capital and bring in, my capital all alongside of my investors, that's great. Other people maybe don't have the resources, don't have those people that they can bring in, but there's something else that they can bring. Maybe they, are young and new and have a lot of time, and so maybe they can help out with the time constraints that the deal sponsor needs. Or maybe they live in an area where boots on the ground is great to have. If you're in a great investment area and you could help find properties and walk properties and that. But the main thing is finding something that you can offer to get into deals. It just so happens I'm out here in Los Angeles, so I'm not buying in Los Angeles, but I can bring money to deals and get into opportunities with other people, other quality deal sponsors. And there's a lot of other people out there, high net worth individuals that have the money, they don't have the time, they don't have the energy, maybe they don't have the real estate education to get into deals and protect themselves, but that's where I come in, that I could play that role where I could help them put their money into great opportunities. And I'm having a lot more fun doing that. It's a lot more enjoyable. I get a lot of my time back. I do it on my schedule. And so I'm able to offer that to my investors.
Yeah. So given that you were a GP yourself, you probably really add value to those potential LPs because, they don't know the ins and outs to the degree of someone who actually operated those properties themselves in the past.
That's absolutely a great point because I've seen a lot of people that are raising equity, that are bringing equity to deals that have not done any deals before. They just jump in and say, okay, this is my spot. I'm going to help raise equity. But they really don't know the ins and outs of deals. And they'll go and look at an underwriting and they say, oh, yeah, that looks good. Well, I've been there. And so I can look at the underwriting and the opportunities and say, I'm not real thrilled with this because there's something in there that I don't like. And I've seen a lot of underwriting that I really don't like. There's assumptions that I disagree with. Now, the other thing is we're in a market right now that is up in flux. We don't know where we're going. And so my big thing right now is how well the deal sponsor is preparing for some of those unknowns. What are they doing to protect the deal? How are they protecting my money and my investors' money in case things don't go the way that they want them to go? Yeah, assumptions are all beautiful. They're all nice. We're going to raise rents. We're going to increase occupancy. We're going to become more efficient and have less expenses. But what happens if some of those things don't work? What happens? The economy starts to turn, and now all of a sudden things aren't going as well. Do you have reserves? What kind of debt are you in? What kind of debt are you? Is a debt going to come due and you're not going to be able to refinance? What if your occupancy goes down? What's your break-even occupancy? There's so many different things that I want to see. What are you doing to prepare for those? What are you going to do to make sure I don't lose my money? And then we could talk about how much money you're going to make me and how you're going to do that. But I want to know how you're protecting me first.
Yeah. And I mean, any underwriting always looks great. It's like when you join those webinars, it's always all bells and whistles, right? And it always sells itself. And I mean, nobody posts underwriting for those webinars that doesn't look promising. But from your perspective, how do you approach those, for example, underwritings or webinars of people, or how should an LP approach it to really secure the downside?
Well, the one thing, first of all, I only invest with deal sponsors that I've gotten to know that I qualify. So first, it's a deal sponsor. That's my first thing. I want to know them. I want to know their integrity. I want to know their past. I want to know who's doing the operations. I want to know about them first. And then I'll go and start looking at the numbers. And, on the numbers, I'm going to go back to look at their assumptions. What do they assume is going to happen, and what's the likelihood of those things happening? And I've just seen some ones, like in a 200 unit property, I saw that they were going to assume that there was two people on the outside, two maintenance people for 200 units, and they were showing that in 2 years they were going to drop down to one. And I'm sitting there looking at this. That's crazy. That's crazy. You're going to have one person that's going to be taking care of 200 units. And this is a company that has done very well, has lots of units, and I just don't understand how they're doing it. And I could go on and on about different things that I've seen that just had me walk away. And I know other people that have raised for these people, and I know other people that have gone into deals with some of these type of assumptions. And, unless you know what to look for, it's difficult, because the end numbers look beautiful. The IRRs look great. The returns, all that look super. But I can do that with anything. I can make the numbers. I tell people I can make numbers dance off the page, but it doesn't matter. It's what's underneath them.
Yeah. But I guess when it comes to maintenance, that's a position that you could, to some degree, take off the books for some time, make the NOI look better, and then you sell the property. It's not, and then it might not be a well-functioning machine that you're selling, but it's still working, and the numbers look a lot better.
Well, yeah, but you spiral downhill though. You stop doing the maintenance. Obviously. Then the thing is not only do it's distracting from the property, but you get your tenants complaining because nobody's taking care of them, or they're taking too long, and it starts to spiral down. You start losing tenants, and then in order to keep tenants in, you have to get lower quality tenants, and you're just going down and down and down. So either you're lowering the quality of your tenants to get people in, or you're lowering your occupancy. So maintenance and getting it done properly is extremely important. Extremely important to keep the property functioning.
I fully agree on that one. Mm-hmm. I was just coming from a seller's perspective. Like if somebody looks at a T3 and you knock down one of the maintenance people over the last 6 months, and then everything starts trending a lot nicer because it's quite a ticket item.
Yeah, I mean, you could go and do that, or you could knock off your office people, and so it's going to look better. So your payroll is going to look better. I mean, there's all kinds of things to do. I know one company that they had a whole bunch of invoices in the drawer that they didn't bother to pay. So the bills were off the books, and all of a sudden, when the new person came on, all of a sudden there's this ton of invoices that are unpaid. So there are lots of things that can be done underhandedly. Yeah.
So how do you help mitigate those things, like for your passive investors, and how do you communicate those things with them?
Well, back to what I said initially is the integrity of the deal sponsor. I want to know what kind of due diligence they did, what they found on the due diligence. I mean, this last deal that I was just in, I asked for the report that they got, because I wanted to make sure that they hired a professional inspector to inspect the property. This at least gets you into the physical plant, as far as what they physically found, and to see what underlying problems there are. But it goes back again to the experience and integrity of the deal sponsor, making sure that they did those things. What kind of audits did they do on the books? Who did their audits as far as leases? We looked at a property a while back, and we did an audit, and it was probably a 200 unit property, and there was 50 units where either the wrong people were in those units, so it was not even correct who was in those actual units, but there was also some units that said they were occupied and they weren't, and others that said they weren't occupied and they were. So you see something like that, and you've got to sit there and dig deeper in until you really straighten things out and figure out what's going on. But we had a property management company that did that audit for us and say, hey, we got to straighten all this out and figure out how many we got. Then on another deal, we came in and we had, out of a 225 units, we had about 30 people that had back rents. They owed over $3,000 in back rents. Well, if somebody's passed a month in back rents, they're not catching up. They're not catching up. They're just going to have to be evicted. There's just no way that they are going to catch up. And so that's 30 people that you could take out of the occupancy and figure, okay, we're gonna lose those people. But they're keeping them in just to keep the occupancy up. So what we ended up doing, though, is on those people, we said, hey, look, we're going to forget about all the back rents. We're going to start you new. As long as you make your payments, we're fine. And so we kept some of those, but we still lost about 2/3 of them. But the ones that we kept, we just wiped out their balance and started them new, and they ended up being good tenants. They just had some hard times and got behind. But if you don't look at those things, if you don't look at those audits and see that, hey, these guys are just not going to catch up, there's no way. You get that. And this was before COVID that they were behind.
Yeah. I mean, if you have multiple months of rent unpaid and you become to that level uncurrent, it's very hard to catch up on that. Like,
absolutely.
Given that rents are major parts of the people's incomes usually.
Yeah, no, I mean, if you're, typically if they're beyond a month, and they're into 2 months, it's just, they may have had something in their life that caused them to get behind. But if they're not on some kind of program where they're working to get that taken care of, typically it's cheaper for them, easier for them just to leave in the middle of the night and go somewhere else. Before they get evicted. So they'll just sneak out and, all of a sudden in the middle of the night, they're gone. So you got to go check to see if there's anybody living in the unit. They'll just disappear. But they're not going to pay that. I mean, it's very difficult for them to pay that.
So what made you shift into real estate in '08, and which industry did you come from?
Well, I was in IT, and I still worked my job for another 8 years after that. I've been retired out of the IT business probably about coming up on 6 years now. So I continued to work my IT job. I just looked at my retirement, and I said, this isn't going to be sufficient. And I was also going through a divorce back then and realized that, okay, my ex is getting my house. I get to keep my retirement, which still wasn't adequate, and I decided I was going to get into real estate. I mean, I did start in the single family world, but at that time it wasn't a great time. prices were starting to drop, especially out here in California. Actually, I was looking at single family homes. I think around 2005. It was 2008 that I started looking at commercial, but 2005. But prices, you couldn't do flips because you go and you get a house, and by the time you get it, the price had gone down too much. We were looking at REOs, bank-owned properties, and the banks didn't have a system for getting rid of those bank-owned properties. And so it could take you 3 months, 6 months before they would even give you an answer on an offer. And by the time they did that, the price had gone down. So if you're looking in there with a $30 or $40 or $50,000 margin, all of a sudden you lost 20 of it, or maybe you lost 30 of it in the time it took them to decide, yeah, we'll accept your offer. So that wasn't working, and that's when I started looking at the commercial real estate, realizing that I didn't really have to have enough of my own money to buy a commercial property. I could use my money to get into the deals, and other people's money to help get into those deals. But my money could get me started with the earnest money and the inspections and stuff. But the down payment, I needed more money for that. So I was able to raise money. So the first real estate deal that I ever bought, besides my own home, was a 20-unit property. So I jumped right in.
Did you self-manage that, or you involved the
No,
property
we had a
management
manager.
company?
This was in Texas, and so we had a management company it was a broker. That's what she did on the side, was management on the 20 unit. And then her husband he was the handyman. He was the one that came and did the fixing and flipping. And she lived about 35 miles. Or her business was about 30. What's that? Yeah, he came in the package.
I said they came in a package.
That was good. He did the handiwork. Yeah, definitely. Yeah.
I guess that also helps.
Actually.
Yeah.
Yeah. They were actually the third management company that I had got. The first one was my broker that sold me the property, and he was terrible. He remains my friend, but I told him I'd never use him as a property manager again. But he was managed for a while, and then he did such a lousy job and got some people in that shouldn't have been in there. And we went through got another management company that lasted 2 weeks, and they ran away from the property. And then we got this other lady, another broker, and she managed the property for about the next 5 years that we owned it. But we went through the two first before we got to her.
So what distinct the lady that was successful compared to the other two? Like, what is something to look out for there?
Well, the thing is she was there. She came to the property. She showed the property. She made sure the rents were collected. And every property management's going to have some weakness. Her weakness was paperwork. So she was able to do the important things that we couldn't do remotely, because I was in Los Angeles and my business partner was in Alaska. So we weren't physically there. So she could make sure that she showed the property, that she got the contract signed, that she got the rent paid, that her husband did the maintenance, but her back end on keeping track of receipts and books and all that crap, she was terrible. So she sent it to my partner in Alaska, and my partner in Alaska threw it into QuickBooks. So we did the books ourselves and kept track of everything and paid the bills and all that stuff. So it was a good relationship that she was able to do the pieces that she could do. The first property manager, the problem with him is, first of all, that wasn't his main business. His main business was selling houses, not managing property. The property was about 35 miles away from his business. Every time he came to show the property, he lost about 2 hours worth of time with his business, his main income. And if somebody was there with money If somebody was there with money and wanted to sign a lease, he signed it if they were qualified or not, because he didn't want to have to come out there again. He also was terrible with systems. I set up a system where people could pay their bills, just either pay it online or drop it off at the local bank. And the local bank was our lender, and so they would keep track of, they would make a copy of the deposit so we knew who the deposit came from. And so we had worked it out that it was real easy for the tenants. We even sent them self-addressed stamped envelopes. I sent them 12 envelopes for the year and said, here, each month stick a check in there and stick it in the mailbox, and makes it real easy. And my property manager, the first of the month, would go and start knocking on doors, collecting rent. And I'm saying, wait a minute. If you're going to come knocking on the door, they're not going to send it in the mail. They're not going to bother to go to the bank. And then when you miss them or they're not there or whatever, then you're going to have to come back and do it again. And they're going to get into that pattern. And he messed it up. He totally messed my system up, because they would rather him come by. Sure, that was easy for them. They didn't even have to take it and put it in the envelope. He would come by for it. But it was 3 times the amount of work for him. So he totally messed my system up. And same with, with vendors. He would come out, he would have to come out and let the vendors in, or the vendors would come by his place and he'd give them a key. So they'd go out there and open up the place, and we'd have keys all over the place. So it was just, he was not meant to be a property manager. Oh, and also I told him we don't accept cash, and he was accepting cash. He was accepting cash and then going to other properties and collecting money with all this cash in. And then one day he goes and says, oh yeah, this other property I go by, there's a bunch of gang members there. And I said, oh crap, that's really nice. You're walking around with a pocket full of money, of my money, and you're going to these other properties, and you just told me there's gang members there. I'm feeling real good about all this. And that was when I kind of said, this isn't going to work. Oh, and I think one time he asked a vendor to collect the rent. He had a vendor collect the rent, and so he had to go out to the vendor. It was a plumber. He said, oh, I got to go get the money from the plumber. I said, great. You got the plumber collecting rent. I said, no, I'm sorry. It was insane.
That's the pain of maybe staying in the lower end of scalability. Like, you've already went for 20 units in that case, but once you get to, I guess, 60 to 100, then you have somebody dedicated to this particular, and you don't have to find somebody who maybe makes that a part-time arrangement for themselves. So let's talk a little bit about the benefits for your passive investors of being in that higher level of scale when it comes to multifamily investments.
Well, the main thing was, and our next property was a 64 unit. So, and we did have a full-time maintenance person and a full-time person in the office. So, the benefit to us mainly is having reliable property management. And that's the main thing. And that's, it's to us as ease of use and professionalism towards the tenants. And, I think it's a better security for the investors. But for us and the tenants, for everybody around, the bigger units are easier to take care of because you do have the professional people on staff. Also, you have a more professional management company. Usually you have, you have several levels where, you got your on-site people, and then you've got either your regional or the main management company that's keeping track of the management rather than it being all in one person. So that makes it a lot better for everybody.
Yeah, so that's really the beauty of scale, and I think that's where it all falls together. There's so many people who think they buy one house and rent it out themselves, or they stay there because they think that's what they know. But the beauty, even for a passive investor, is to work with people like yourself, that have the experience, do know how to vet operators, do know the GP side of things and how to operate a space, and then also on top benefit from the economies of scale of buying large multifamily complexes that really have professionals at every corner of the project.
Absolutely, absolutely, and I've run a bunch of clubs out here locally, and people are always talking about single family homes, and some of them want to do it locally, which is fine, but we're in, I'm in the LA area, and it's very expensive, so they say, okay, I'm going to do single family homes or duplexes or quads, out of state, and to me, I find that extremely risky. Because typically, one, you don't get the quality of management company that you would, because maybe the manager, what are they making, $50 off you, $75 a month off you? Okay, so you don't have the quality of the management, and unless you have a lot of properties, you're just a little fish out there. Now, I know a lot of people that are lucky, that have gotten good tenants, and they have them for 5 or 10 years, and they take care of the property. But I hear a lot of other horror stories where the property isn't taken care of, the management company doesn't get anybody in there. They take the first month's rent when they lease it up, and then the person's in there for 6 months, and there's damage, and so they got to fly out there, and whatever profit they had, is gone. To me, it's a lot more risky when you're the one that is on the note, you're the one on the mortgage, and you're getting little dribs and drabs of money. It's not to say that people haven't been very successful at it. There have been. But that wasn't my thing. I didn't want to get into that. I would rather know that I have a professional company taking care of this asset. But yeah, you're absolutely right. There's people that are doing that. There's people that will do it from start with a single family and get duplexes and quads, and then they sell that and they get a 20 unit and a 40 unit, and they work their way slowly up. So it's doable. People do it. It just wasn't the path I wanted to take, and it's not my preferred path.
Yeah. And I also think it's not necessarily needed. Like, you don't have to start with a single apartment to eventually participate in 100 apartments, especially not with people like yourself that help people getting invested.
Yeah, absolutely right. And the thing is people have to kind of look at their own situation and see if they want to be an active investor or they want to be a passive investor. There's a lot of people out there that think that they want to be an active investor, and they have a full-time job, and maybe they're making a lot of money at that job, and they enjoy their job. Maybe they like their job and they don't want to leave their job, but they still try to be active. There's others that say, okay, I'm willing to give up some of the control and be a passive investor. And, that's great for whatever they want to do, but being an active investor, may not be all that people think that it is. I mean, it could be, it could work out. Sometimes it does, sometimes it doesn't. But being a full-time employee, even a highly paid full-time person, you may just not have the time to put into it. And so, everybody has to make their choices. Obviously, as a passive investor, you're giving up some control, and that's all part of it.
Yeah. So looking at kind of the overall environment we are in right now, what's your take on, for example, where are interest rates moving, and how do you protect your passive investors that are along on this journey with you?
Mm-hmm. I'm concerned about what's going on with the interest rates. I see a lot of people getting into debt that has maybe a 3-year length on it, and their plan is to either refinance or sell in 3 years. And depending on what the environment is, if they're going to be able to do that. So that's one of the concerns I have as far as, okay, what happens, they may have a 3-1-1, so they've got They've got another, 1 years that they can extend the loan, another 2 years they can extend the loan, but we don't know at what rate. I like the fixed rate debt a lot better, but that's harder to get. That's expensive. But that's definitely a concern. The other thing is if you decide to sell in 3 years, who's going to be the person out there that's going to be buying your property? If the interest rates are too high in 3 years, what value are you going to be able to get for your property? I feel that in the next 12 to 18 months, there's going to be a lot of people that have been in loans for the last couple of years that are going to be coming up. And they may not be able to sell for the value that they want. So there may be some great opportunities coming. So I'm definitely concerned about it, but I'm also looking at different asset types besides just multifamily. There's also, self-storage, there's mobile home parks. I'm looking at some development stuff. We bring in opportunities into the fund that have different returns. A lot of the multifamily, typically most of your return is at the end. It's capital appreciation. Well, we're looking at a lot of opportunities that have immediate cash flow, more so than just the multifamily. So diversifying, I think, is a good idea as well. Not just one aspects of commercial real estate. There's all different other aspects of commercial real estate, and that's some of the things that we're looking at getting involved with. Because I don't know. I don't know where the interest rates are going to be. I don't know if we're going to get into a recession. I just want to know what is being done to spread the risk out and to protect against the risks.
So in which of the assets that you are part of do you see the strongest cash flow in the current environment? Well,
I do see some in the mobile home parks. They seem to be doing pretty well. Self-storage does well in both recession, in up markets and down markets. One of the things that seemed to be a growing trend that I'm looking at is build to rent, where it's development, but it's developing with the end is to sell to investors or to rent it out as it would be an apartment complex, which gives some great cash flow. As you build a unit, you can either sell it off to investor or lease it up, and you've got cash flows. One of the things I was looking at was the Bitcoin mining, except then Bitcoin went down. So that was one that is of concern. But eventually Bitcoin's going to come back, and the Bitcoin mining will come back. I know other people in an ATM fund. ATM funds keep on going no matter what's going on. That even though there's Venmo and all the other kind of electronic transactions, ATM funds still seem to be doing well. I haven't invested in those, but I know people that have been very successful with those as well. Assisted living is something that that's definitely going to be needed, as we get an aging population. So the thing is being able to have the opportunity to look at all different asset types and invest in different ones. With the fund that I do, it's customizable, which means that my investors get to pick and choose which of the opportunities they want to be in, so they get the last say-so if they want to be in an opportunity, and pick and choose, and can diversify across different asset types. And as we all know, different asset types go up and down in their own cycles, and that way you're diversified and more protected. So that's where I'm looking at this point, is to get more different types of assets in my fund and help my investors to protect themselves.
What is one of the preferred assets that your investors are looking for?
Well, I mean, most of my investors have been with me for the ride on multifamily and student housing, but I'm in the process of educating them on some other opportunities. So that, some of those other ones that I mentioned, they may not be as used to those, but I just have to tell them, let them know why I feel they're great opportunities. And then it's up to them to decide if they want to join us in those particular opportunities. But right now, multifamily, I'm concerned with it. I'm very cautious about who I'm investing with in multifamily. I may hold off on multifamily for a little bit, but there's other opportunities. I know a lot of great operators, multifamily operators right now that are developing new multifamily instead of buying already built products. So because they've been seeing how expensive and how much overpriced properties have been. So they said, well, if I'm going to pay that much money, I might as well buy a new one.
Might as well build a new one,
So a lot of people
and participate in that.
That's right.
But obviously, it's also a different pitch to your investors. Once you start developing, there is no cash flow, in the early stage, and there's no. So it's a different set of investors that's looking for those opportunities usually, right?
Yeah, except that the build to rent kind of mediates that. If you're going to build an apartment complex, obviously the whole thing has to be built. You have to get your certificate of occupancy. Then you have a long time to lease up before you even start breaking even. So it could be a couple of years before you're going to see any money. Build to rent, what I like about it is as you build out each unit, it may be a single family, a duplex, it may be a fourplex. But as you build that out, you get a certificate of occupancy on that particular property. And now you could go and either rent it out or sell it. And so now all of a sudden you're getting money coming back in. So you could see money flowing back in a lot faster. Now the other opportunity that I've seen that I didn't mention is also we're looking at a short-term rental fund where you have 50 short-term rental properties in one fund and you get the benefit of those. And those are high cash flows. Those are high cash flow opportunities, not so much the capital appreciation, more cash flow opportunities. So that's one that I'm looking at this point, the short-term rentals, just to see where they are, certain locations for the short-term rentals.
Yeah. So, Chef, we're actually coming up to the end, and one of my favorite questions that I always like to ask is, what does it mean to you to have a life well lived?
Well, a life well lived is to be able to help other people. Obviously, everybody wants to do something for their family. And of course, that was my initial why, my initial reason for getting into real estate was to help my family. But if I could help others on the way to help their families, to help their well-being, to help them help their families, then it makes me gratified. If I could give you a quick story of one of the most gratifying events that happened in my real estate career is where we have a property. I still own this property. It's student housing in Georgia, very low economic area, and we bought a property. It was 30% occupied. We fixed it up. We renovated the whole building, put furniture in, whatever. And afterwards, I started interviewing. This was student housing. I went down there personally and interviewed the students for a advertisement that we wanted to do. And the question I asked at the end after interviewing these young people is, I always asked, if you had an opportunity to talk to the owner, what would you say? Because they didn't know I was one of the owners, or they didn't know I was the main GP. They just thought I was somebody that was videotaping. Anyway, and this one young lady went and said to me that she was happy that now she lives somewhere that she can show her mother, that she wasn't embarrassed to bring her mother to where she was living. And even now that brings tears to my eyes. That was so moving to me. I asked her if I could give her a hug, and I did, and it was a very sweet moment. But that was so gratifying that this young lady felt that way. She felt safe in our property. She felt proud to be able to bring her mother to the property. And because otherwise, when we first went there was nothing. There was drugs going on. There was all kinds of crap going on. And we got all that cleaned up. But to be able to do that for one of my tenants, and she wasn't the only one, but she was the one that said that. And that was very moving to me. So that being able to give people a safe environment, a clean, safe environment to live on all of our properties is extremely meaningful. That's so rewarding, above and beyond everything else.
Yeah, I love this part, and I think it really hits home for me, because that's also one of the reasons I appreciate and love real estate, is because, we get to do those things, and we get to take care of communities as much as we get to take care of our investors and therefore their families.
Mm-hmm. Absolutely. To be able to do good while
Jeff,
we're doing well.
Yeah. Yes, exactly. Well, Jeff, thank you so much for your time. This been very insightful, and thanks for sharing your journey. Where can people connect with you?
You can get me at Jeff at Synergetic, SYNERGETICIG.com. And I do have something for your listeners. If they go to sigcre.com/sponsor, I have a list of questions to ask deal sponsors before you get involved and invest with them. So that was sigcre.com/sponsor. And you could learn, some of the questions to protect yourself when you're getting involved with the deal sponsor. They are the jockey, and they're the important person to learn about.
Yeah, that's awesome. We'll also make sure to write it out in the show notes so people can just click on it.
Sounds good.
Awesome. Thank you very much, Jeff.
Well, thank you for having me, and this was fun. This was great. Thank you.
Thank you for joining us at The Path to Wealth. We hope you enjoyed today's episode. Check out our upcoming guests and be sure to share it with all your friends and family that want to take their life to the next level of wealth.